Hi, everybody. Good morning, good afternoon, good evening, wherever you are around the world. My name is Rose Joshua. Welcome to Family and Finance, where we provide you with free information that will help you in your financial decisions. So today I'm going to continue from my teaching last week. I did talk about benefits and dangers of term insurance. Today, I'm going to do a deeper dive into that just to provide a bit more information and enlightenment for your financial decisions. So I'm going to share my screen. My title today is, when term life insurance costs more than permanent life insurance. Okay. Yeah, that does happen. Okay, so let's proceed. So you'll recall from last video that we did say that term life insurance is good. If you have low cash flow, if you have temporary needs, term life insurance is good. It's better than nothing at all. Like we said, don't delay covering yourself simply because you don't have the cash flow for permanent policies. It's better to get term insurance than to have nothing. Again, because that unpredictable thing about nobody knows tomorrow, nobody knows the day they're going to die, right? So remember that life insurance is really to take care of your commitments in the event of death. So term life is good, but if you can afford to get universal life insurance, a permanent policy, is better than term if you can afford it. And we try to push for being able to afford that as soon as possible. So how in the world can term cost more than permanent? How in the world does that happen? So before we go into that, I just want to caution you. Every day we hear thousands and thousands and thousands of advertisements bombarding our brains. Everybody wants your money. There's, thousands and thousands and thousands of companies that want you to buy their products. So you've got to be careful out there. Don't believe everything you hear. Don't believe everything you hear from your friends. Sometimes friends don't know. They just say things they don't know. Don't believe everything you hear from the ads, because again, the ads are the companies wanting you to buy from them. Again, sometimes many times when our companies are advertising, they don't tell you the negative stuff. So for example, if you remember when Adam and Eve were in the garden, the snake did not tell Eve the negative side of eating the fruit. They just said, oh, you're going to be smart, you're going to be wise. And so consequences, people don't discuss that. So be very careful with ads. And bottom line, you want to analyze your numbers. You want to crunch the numbers before you make your purchase. You need to be an informed buyer. Don't just buy anything because somebody says so, okay? So recall again, the term policies, the entry premiums are very low. So they are a very big temptation, very big fish bait. Remember the fish? They put some nice juicy stuff at the end of the hook. And once you're caught, you're in trouble. Once you catch that bait or take a bite into that bait, it becomes a problem. So term insurance is good again, but not for end of life decisions. So that's really what we're talking about today. So beware also of sexy slogans. I want to call them the double S. There's this thing that flows around, buy term, invest the difference. That's a dangerous slogan, okay? Because invest the rest or invest the difference is actually not mathematically correct. So I have a PhD in computer science, so I can basically talk up to you about the numbers. It's not mathematically correct in every situation, especially in the short term. So a lot of people say you buy term, invest the rest because they want to replace the life insurance value face amount with their investment. Many things wrong with that. Number one, is not mathematically correct, and I'm going to show you a few numbers down the road. And number two, how many people actually invest the rest? Remember that one of the reasons people say, I don't want to buy permanent, because they say they don't have money. So where's the rest they're going to invest? So it becomes a double jeopardy when you buy term and you don't invest the rest. Okay, so we're going to talk about that. So again, crunch the numbers, be an informed buyer, make an informed decision, all right? So let's now take a look at how term life insurance can be more costly. So remember the word we're using is costly. So we're not talking about the premium amount, we're talking about the cost. And so it's gonna be a combination of premiums and actually the face amount. So let's take a look. So today I'm going to introduce Universal Life. It's a type of permanent life insurance. It's overfunded to create what we call a cash value, and it is paid for a limited time. So if you pay and it's invested, you accumulate a cash value that covers the rest of time that you would have been paying, right? So cash value then is used to pay the premium on your behalf when you're actually not doing out-of-pocket payments, okay? So cash value can be used for many purposes like education, buying a home, down payment, other projects. Now, it is, at face value, it is more expensive, okay? But I like to say it appears more expensive, but in reality, it could be lower cost. And that's really what we're gonna talk about today. Is a case of you comparing a bicycle with a Mercedes-Benz, right? So bicycle, Mercedes-Benz, the Mercedes-Benz is more expensive at face value, but overall, you're spending more when you have the bicycle because you don't have, by the time you've bought, your bicycle has lasted a year, you need another one, then you need another one, and you need another one. And by the time you've spent all that money, you might as well have bought a Mercedes, right? So that's really the way it works. So let's take a look at the previous examples that we did. So in the previous example, I showed you a healthy situation and unhealthy situation. Let's assume a healthy situation for now, best case, unhealthy situation, worst case. So in a T10, you're spending about $71,400. By the time you're 80 plus 1 day, the policy is done and you've lost, your family would have lost the potential payout of $300,000. In an unhealthy situation where you auto-renew, so if what I'm saying is strange, go back and watch that other video, video number 13, I think it is, but the title is Dangers and Benefits of Term Life Insurance. Go watch that one, just so, because we're building on it here. So in an unhealthy situation, which is auto-renewed, you're spending a lot more, $100,000 more. And again, if you outlive your policy, you've lost your money. So we did also a T20 example. So now let's take I'm going to pause on this page for a long time. So now let's take a look at if the same person bought a universal life, or let's say you have two brothers. One buys the $25 T10, and the other one buys the $335 universal life policy. So the difference is a lot of money, but we're going to analyze it. I'm spending some time here. So let's say, for example, the brother A, of course, is healthy and is able to renew at good premiums. So scenario number one. So cycle number one, age 40 to 50, you pay 25. Cycle number two, age 50, you pay 45, and so on. At the end of that first cycle, you've paid $71,400. By the age 80 years old. The other brother got a universal life policy, pays for 10 years. This is a 10-pay example. Overfunds it for 10 years, pays $335, and is done paying in 10 years. So that means that from age 50 to age 100, there's no more money needed because now the cash value is carrying the policy. At the end of the life of this person, he would have paid $40,200. And he has a $300,000 policy. So when he passes away, his family would have the $300,000. It's actually more than that because the UL is invested. So it tends to be more like maybe it might even get to 350, 380, depending. All right. Let's say this person lives to age 81 and passes away. His family would have lost $300,000 potentially, and he would have lost out of pocket $71,000. So the cost in the first scenario of buying a term policy and renewing it, the cost is $371,000. Okay, so you lose the money that you paid as premiums, and you lose the benefit that your family would have got. In the UL, you get the benefits. It's invested, so it tends to be higher than the 300,000 anyway, and you only paid 40,200. If the person was unhealthy and was stuck, had no option but to do the auto renewals, you would have paid $173,000 for premiums, and after age 80, you would have lost, your family would have lost 300,000. So the loss there will be $473,000. So by buying a term and not converting it, you expose yourself to a double jeopardy of losing out-of-pocket money and losing benefits that your family would have got. Okay, so mathematically, you've got to crunch the numbers and know exactly what you're heading into. You have to remember that the premiums you pay in a term insurance policy is never recovered. Okay, so let's say you fall to the bait of buy term, invest the rest. Over a 10-year policy, so for the first cycle, brother A pays $25, brother B pays $335. The difference is $335 minus $25, which is $310. If you invest, take a look at your compound interest calculator. If you invest $310 a month, which is the difference, invest the rest, invest the difference. If you invest $310 a month for 10 years at the rate of return of 8%, you only have $56,713. You're not anywhere near replacing that policy. You're so far away from replacing that policy. Okay, very, very far from 300,000. So that's why if you look at your account balance at that time, you have to renew because you don't have 300K. You cannot invest the rest in a short-term 10-year period and get your full coverage amount. So again, be very careful what you listen to. So let's take a look at a T20 situation. So T20 now. Brother A buys a T20. He's 40 years old, T20, he's healthy, $33. Brother B buys this permanent universal life policy, $215. The difference is $182, okay? So again, if you invest that difference of $182 for 20 years, you are only at $107,000. So again, after 20 years, you still have not replaced that 300,000 policy. It takes time, guys. It takes a long time to invest the difference and replace your policy. If you have like $1 million policy, you would have to do pump a lot of money into an investment to replace your term policy, and it takes time. I did the numbers. It takes at the very least 35 years to replace most of the policies if you're doing invest the difference, okay? 35 years. So guys, we have to be very, very careful what we listen to. Deadly slogans out there just to get your money. So be very careful. So in this case, a T20 again, in a healthy situation, this person has spent $75,000. And at age 80, 81, if he outlives his policy, he would have lost $375,000, $300,000 potential that his family would have got, and $75,000 out of pocket. Okay, so it's double jeopardy. All right. So if you look at it, the only time that the universal life permanent policy is really more expensive than the term is if the person dies young. So if you die young, for sure, yes, you would have paid less if you die young. So, but who wants to die young? Everybody, if you, I ask, oh, I want to live to 100, I want to live to 85. The life expectancy of Canadians is 85 years plus. I see a lot of 90, 95-year-old people who are still driving their cars happily, right? So it is the probabilistic factor is that your probability of living longer than 80 is high. So be very, very careful with getting stuck in a term policy that ends at 80 or even 85, because again, nobody knows when that's going to happen. So the only time permanent policy really costs more is if you die in the early years. If you live long past the expiry date of a term, then you're in trouble. Okay, so be wise in making those decisions. So here's a summary of today's teaching, is that term life may appear to be innocently cheap, very cute, inexpensive, easy to pay, term policies, but over time, it costs you more. So the low entry fees are a very, very dangerous bait. Be very careful. So it's better for you to say, you know what, close your eyes, take the bull by the horns, and actually get yourself a policy that gives you peace of mind, a policy that gives you sleep at night, because you know you're covered for life. Okay, permanent policy covered for life. So again, only take time if and only if you don't have the money. But again, like you said, it's better to have term than nothing, but it's better to have, it's best to have a permanent policy, okay? And again, the only time is cheaper is if you die young. But do you want to die young? I guess, you need to ask yourself, do you want to pass away young? No. If the answer is no, go out there, and if you can pay for it, get yourself a permanent policy, okay? So if you have a term insurance policy today, I want you to connect with me. Let's take a look at it. Let's review what must be permanent, what can be term. And, based on your cash flow, we'll try to get you the best option. Again, is suitability. You need to be sure that you're covering yourself so your family, you can have peace of mind that you're taking care of your family, okay? And that you're taking care of your commitments. So again, give me a call, 780-680-1334. And don't forget to subscribe. And please send this video to your friends and family and have them call me and subscribe as well. Thank you so very much, and have yourself a beautiful, beautiful day. Okay, bye.